Hi, students. Welcome back to our final lecture of the course. In this class, we're going to talk about derivative mishaps and the pitfalls therein. So, we're going to spend most of our time inside eight specific failures, just sort of, examples, and then step back at the end to attempt to extract some patterns in the data. The discipline today is going to be a bit more forensic. We're not, here necessarily to mock people who lost billions of dollars. We're here to figure out what they got wrong so we don't repeat it, right? So every imperative in section four in particular here is written in someone else's, blood, frankly, right? And almost every imperative was relatively obvious in hindsight to the people who did not see it coming. So, so why should we study derivative disasters? Now, first, there is the issue of survivorship bias. What do I mean by that? Well, textbooks teach us that the strategies, teach us the strategies that do work, but the strategies that blow up or blew up teach us where the strategies that worked have some hidden weaknesses. Um, Second, the same five or six failure patterns tend to repeat. Okay. So once you see them, you'll be able to see them everywhere, including in the trades that you're tempted to make yourself. Third, is from regulation. And almost every major piece of derivatives regulation since 1994, you know, either risk-based capital, FAS, the FASB ruling 133, Dodd-Frank swap executive facility rules, central clearing, all that was written in direct response to one of the cases we'll look at today. So, if you don't understand the cases, you don't understand the rules. And the last thing, of course, is that nobody is immune to these disasters, and we'll show you an example of some Nobel laureates who also blew up. All right, so here is our scoreboard of failure. Um, these are the documented losses from specific derivative mishaps prior to the global financial crisis in 2008. And of course, the subprime crisis added even hundreds of billions more to these totals. But what's interesting here is that the split between non-financial corporations and financial institutions, the failures are roughly equal in dollar terms, right? Which, might surprise you, right? A common assumption might be that banks blow themselves up, right over here on the right. But in fact, industrial corporates here on the left lose comparable money using derivatives poorly. For example, Procter and Gamble, they lost $90 million dollars in a leveraged swap that they did not understand. And Allied Lions, as another example, lost 150 million dollars selling foreign exchange options to fund their pension program. So these aren't stupid companies. They're companies that really just didn't know what they had bought. So here's our eight cases, and we start from the municipal bond portfolio of Orange County in 1994 and end with something more recent in Archegos capital. So here's the case on Orange County. Robert Citrone was the county treasurer of Orange County, California. It had an investment pool of about $7.5 billion in the portfolio. And of course, they were holding, the corporate, the county treasurer's job is to hold the operating cash of the entire, all the school districts in the county, plus the public agencies. And, Rob Citron was particularly well liked because he generated really strong returns for years for the county. Typically something like 200 to 400 basis points over comparable, counties, right? So 2 to 4% more. So it's really, pretty compelling. Now, the structure that he implemented was to buy something called inverse floaters. Inverse floaters kind of act like fixed bonds, right? Like a normal straight bonds, except the price of the bond doesn't fall in this case. The coupon falls when interest rates rise. So it has that kind of similar flavor. They're just called inverse floaters. Now, the crazy part was that he'd buy these and use these as collateral to then issue floating rate repo loans, right? So they were borrowing in the floating rate market. And then they would buy more inverse floaters, and then they could use that to fund even more floating rate repo borrowing. So by 1994, the pool was levered roughly three times. Um, and just as a reminder here, the inverse floaters pay a coupon that goes down when the short-term rate goes up. So the entire structure was a one-way bet, right? A one-way bet that short-term rates would stay low. So obviously you can see here the problem that this is essentially a giant bet on duration, right? These are bonds. He's got a one-way directional bet on interest rates, and the interest rate bet is that interest rates will remain low. But this is sort of dressed up, if you will, as a cash management strategy. Um, okay. So, what ends up happening? Well, in 1994, this is when Alan Greenspan was head of the Federal Reserve System, who recently passed away, actually, last week at the age of 100. And during that year in 1994, um, the Federal Operating Committee decided on six rate hikes in the short-term interest rate market. And they went from, something like 3% to 5%, 5.5%. So for Citron, this was lethal in two directions at once, right? The fixed rate inverse floaters fell in market value and their coupons reset down, while the floating rate repo borrowing, that went up. So this is a textbook duration mismatch, right? And given that it was amplified by 3x leverage, it hurt quite a bit. So by December of 94, the portfolio had lost, roughly $1.7 billion. Um, And as a result of that, in early December of that year, the county filed Chapter 9 bankruptcy, which is the largest municipal bankruptcy history in the time, U.S. history at the time. The fallout from this was roughly, once they sort of unwound all these positions, about $2 billion total portfolio loss. 3,000 county employees were laid off. You can see here 185 school districts had operating funds that were frozen. Um, Inevitably, Citron pled guilty to six felonies, but he didn't serve any time in prison. This was largely on house arrest. His broker, Credit Suisse First Boston, paid, roughly $800 million to settle the civil claims. And the big lesson really here is that nobody at the county board of supervisors could really explain the strategy, right? They were told, quote unquote, cash management, and they just kind of took it at face value. Our second case here involved a company I think we've talked about before in this class called Metallgesellschaft. And MG here, we're going to call it. This is a 130-year-old industrial German conglomerate at this point. It had a U.S. division that was an oil marketing subsidiary. Um, in the and we're going to call this one MGRM. I forget exactly what the acronym stands for. Metallgesellschaft something or other. Um, but they did something supposedly clever in late 92, early 93. And what they did was sell long-dated fixed price oil supply contracts out to, 10 years, right? To, small US gasoline retailers, right? So that Texaco on the corner or the Hele gas station right around the corner, right? Now, these contracts are obviously valuable to the customer because they price in that certainty of of gasoline deliverables out for a decade. And the trade-off was that Metallgesellschaft would generate a good margin from this, right? Now, the challenge, of course, was how you would hedge this. So what do they do? There's really not much you can do because there's no liquidity in the 10-year crude oil futures. So MGRM's answer was to put on a stack and roll hedge, right? You pile the entire hedge into the front month, in this case, the NYMEX crude contract, and roll it forward every month. This strategy is economically equivalent to a long-dated hedge, but on paper, right? That is, if oil prices rise, um, the futures gains offset the higher cost of supplying these customer contracts. And obviously, if prices fall, the futures losses are offset by the increased value of the long dated contract. Now, the problem is the cash flow timing, right? So, as you can see, what's coming, right? Oil prices fall sharply at the start of 1993. Remember, this is coming off of a year and change after the end of the first desert war in the Middle East in Iraq. Um, and so there's no more supply shocks necessarily. So oil falls from roughly $20 a barrel to something like 14, 15 bucks a barrel. Now, the futures position, remember, it's a long stack and roll crude oil futures. It generated something like $1.8 billion in margin calls, right? So this is real cash due now to the NYMEX, the New York Mercantile Exchange. Now, the offsetting gain on the long-dated customer contracts was real too, but this is an increase in economic value that would be realized over 5 to 10 years. This is not cash right now to service these margin calls. So MGRM's German parent was looking at quarterly statements, and they saw a massive cash hemorrhage. And so they forced an unwind of the long futures position in December of 1993. Now, by unwinding the hedge at the bottom of the oil price drop, they crystallized, right? They locked in the futures loss, but they kept the promise to the customers, right? And over time, that appreciated when oil rebounded. So MGRM no longer had the futures position to hedge, and they still owed deliveries on a higher price of oil gas contracts. So the net loss on this was $1.8 billion. Now, there was a serious academic debate that went back and forth, but either way, essentially a hedge that requires um, more cash than the firm has is not a hedge, it's a bet on liquidity, right? Our third case here talks about a rogue trader at a bank that had been around for a long time. So Barings Bank was founded in 1762, and it actually helped finance the Louisiana Purchase back in the day, as they say, right? And in fact, the Queen of England at the time banked there as well. So this is like the Queen's Bank. Um, but by 1995, all of this goes away because it gets wiped out by a 28-year-old trader out in Singapore. That trader's name is Nick Leeson. He was Barings' head of derivatives trading at the Singapore Mercantile Exchange, the SIMEX. Um, Now his job was supposed to be, small scale arbitrage between the Nikkei 225 index futures contracts between two markets, one in Osaka, Japan, and in Singapore, right? So basically capturing pennies difference, your classic arbitrage that we've set up during class. And ideally, it's set up as riskless. Now, critically, um, looking here at the control failure, Leeson also ran the back office in the Singapore division. So that included the settlements, the reconciliations, and the confirmations of the trades. So, as you could imagine, these two roles should never be combined. So this structural failure made everything else possible. What he did was create an error account in the computer system called, was this 5/8 here, 8888. That error account allowed him to hide all these losing trades. So over a 2.5 year period, instead of doing an arbitrage, he was actually running massive directional bets. Specifically, he was using short straddles. Um, Remember short straddles. If a straddle looks like something like this from our diagrams, a short straddle looks something like this. So he's basically short volatility, meaning he's betting that the price is going to remain in the middle somewhere, kind of like a butterfly hedge, a butterfly strategy, but without the wings to protect him. Okay. So he ended up with this short volatility position on the Nikkei 225 plus an enormous position in long futures position. Okay, so now he's got short vol and long on the market. So the notional exposure at the end here runs something like $27 billion. So this is multiples of Barings Bank's entire capital base. Uh, Nobody knew what was going on at Barings, particularly in the headquarters in London, because the same person reporting the P&L, the profit and loss statement of the Singapore office was also the one running the trades. So what happens here? Well, these losses are accumulating, and he's hiding them by the middle of 1992. Now, in January of 1995, right, over this 2.5 year period when he's building up these positions, really strong earthquake hits Kobe, Japan. And Leeson's short vol position, which was already underwater, and his long futures position just bled even more. So this was sort of a catalyst towards the downside. Now, of course, a rational trader faced with these losses would have unwound the positions, but he doubled down. He bought more futures position, betting on a rebound in the market. That rally never comes, and so by late February 1995, um, uh, he realizes that these losses are so large they can't be hidden anymore in this error account. So he flees Singapore, right, in February 23rd, and Barings discovers this over the weekend and declares insolvency 3 days later. Um, and in the aftermath here, ING, which is a Dutch bank, acquires the remaining assets of Barings Bank for £1 British. Um, so, you know, take this historical timeline serious, right? 233 years of institutional history um, gets extinguished in 39 days because one person controlled both trading and the reconciliation of those trades. So, this is oftentimes the most single-sided case in support of the segregation of duties in a bank and the regulatory response that produced what the modern operational risk framework that we practice today. Here's another case for you. Case number 4. This is a case about long-term capital management. Now, on paper, this is the smartest hedge fund that ever was assembled. So this hedge fund included Robert Merton and Myron Scholes of the Black-Scholes-Merton model formula. They were partners, along with David Mullins, who was the former vice chair of the Federal Reserve, and a guy by the name of John Merriweather, who was the legendary head of Solomon's arbitrage desk, who ran the firm. So in 1994, they raised about $1.25 billion and proceeded to lever it on to the tune of 30 times, such that they were running with an immense amount of exposure. What was their strategy? Their strategy was a relative value, or sometimes called a convergence trading strategy. And the core idea here is, like we've talked about before, in the arbitrage setting, when something is cheap, and one is expensive, you short the expensive one and buy the cheap one and wait for prices to converge, hence called a convergence trade. And the classic example that they were running was on the run versus off the run treasury bonds. Both are obviously obligations of the same issuer, in the US government, for example. And oftentimes they would use the same maturity, right? It turns out that on the run securities tend to trade more expensively because dealers wanted to hedge their books. And off the run treasuries are ones obviously that were issued some time ago. There's not much liquidity in them, so they trade a bit cheaper. So the strategy was um, to buy the off the run securities, right? Treasuries, which are cheaper, and short the on the run and harvest a few basis points along the way. If you repeat this 1,000 times and lever it 30 times, those few basis points become something like 40% annual return. And for the 3 years after setting up the fund, they put up 40%, 41%. And then I think in 97, it was something like 17%. And then 1998 happens. So what happens? So in August of 1998, Russia defaults on its own ruble denominated debt. Now, this unsurprisingly was unexpected. That is, sovereign entities historically default in debt that's denominated in a foreign currency. Defaulting on a debt in your own currency, right, sounds ridiculous because you can print your own currency. So it was considered unthinkable. So what was the global response? Well, global response was a flight to quality. Investors dumped every risky asset and bought on the run US treasuries and German bonds. And so the result was that essentially every single long-term capital management trade lost money at exactly the same time. The on the run, off the run spread widened, didn't narrow, didn't converge. And their positions were structured assuming that these spreads were uncorrelated during stressful times. So, in fact, of course, all spreads are driven by the same factor. In this case, risk appetite, and they all widened out together. Um, so the correlations, in the model that were near zero became essentially near one. So within 5 weeks, long-term capital management lost roughly $4.6 billion, which represented about 90% of its equity. And the Fed orchestrated a private bailout to the tune of $3.6 billion by 14 major banks because their positions were so large that a forced liquidation would have moved markets enough to threaten the solvency of its counterparties. Now, this is the canonical example of model failure under stress, right? The correlation in this case. And an example of too big to fail before the term existed, right? Which got coined during the global financial crisis. Our next case is about the French banks, Société Générale, also known as SocGen. Um, Their junior trader, Jerome Caville, or Jerome, he worked on the company's Delta One desk in Paris, right? So they're sort of hedge fund desk. And what that desk did was just plain vanilla, low margin kind of arbitrage in equity index futures. Now, Jerome had previously worked in the bank's middle office, which meant he knew exactly what the control checks looked like and exactly how to defeat them. So, starting in 2005, he began building directional long positions. These were unauthorized. And he was building a long position in the DAX, which is the German index, Euro stocks, which is Eurozone, and FTSE futures, so the UK. And to hide them, he was fabricating offsetting trades, right, to make it look like a hedge. These are essentially fictitious short positions with fake counterparties. Um, Now he forged emails even to confirm these trades. And over a 3-year period, he was flagged something like 80 plus times by internal controls, but each time he produced plausible, hand wavy documentation and was waved through. So by early 2008 in January, his notional long position was about $50 billion in notional exposure, which was larger than SocGen's entire market capitalization. So the actual loss on Curville's positions when discovered might have been manageable, but SocGen made the loss even worse. How did they do that? Well, um, their position, Curville's position was discovered on January 18th, 2008. So the company had a choice. They could immediately unwind over a week or two, or unwind quietly in the open market and then announce it after, right? So they could announce it immediately and then unwind it, or unwind it quietly and then announce after. So they chose to unwind. They began selling on Monday the 21st. Um, and on that same day, European markets had a gap down opening of 7%. This is sort of the beginning of the fears of the global financial crisis. So recession fears were taking hold on that Monday. And over a 3-day period, SocGen sold the entire $50 billion notional position into a market that was already collapsing. So, according to independent analysis, the Um, the independent analysis suggests that their selling contributed to the magnitude of the drop in the European markets, which in turn triggered an emergency response by the US Federal Reserve System of a 75 basis point rate cut on the morning of Tuesday, January 22nd. Now, at that time, that was the largest single day cut since, 1984. Um, and so the market really didn't know when the Fed cut that the European drop was being partly driven by this one bank, right? Dumping all these index futures on the market. And then on January 24th, SocGen announced that they ended up with a $4.9 billion loss in Kerviel's position, which grew to $7 billion because they were selling into a downtrending market. So Jerome was prosecuted, and SocGen was found partially responsible by French courts for negligent oversight of Kerviel's position. So the lesson, the takeaway here, is that how you exit a problem position in this case, is often more important than maybe the position itself. They should have done it on a much more orderly basis, taken their time, as it were, to do so. Another of these cases is a case on a hedge fund and a multi-strategy hedge fund called Amaranth Advisors. Um, Amaranth was running about $9 billion, and they had a star trader. His name was Brian Hunter, and he was a natural gas trader. Um, and he'd previously been fired from Deutsche Bank under some suspicious, disputed circumstances. But that's just sort of a precursor to what comes next. His main strategy was to bet on calendar spreads between winter and spring natural gas futures. Right? He would go long, like the March contract, and short the April contract on that, the theory that storage drawdowns, remember these seasonality effects in convenience yields and storage, um, on the theory, of course, that the storage drawdowns in the late winter, sort of March, create a predictable price pattern. And it worked pretty well, in fact, in 2005, especially during Hurricane Katrina, which decimated some of the natural gas ports in the Gulf of Mexico. Now, in 2006, Brian Hunter scaled it up pretty dramatically. By the summer, he was holding positions of, something like 40 to 50% of the total open interest in certain of the natural gas contracts. Meaning, the rest of the market combined was less than him in some cases. So this is a clear liquidity trap, right? When you're 40, 50% of the market, you can't exit at the market price. You are the market. So when spreads moved against him in September of '06, there was nobody to sell to. Um, and as a result of that, Amaranth loses $6.6 billion. All right. $6.6 billion in a single month. So this is more than 70% of the fund's capital. And of course, the fund collapsed. Hunter was fined $30 million by the Federal Energy Regulatory Commission, the FERC. And, the fund had just been up 30% plus year to date through June before this catastrophic blow up. And I remember this time well. In fact, Amaranth was on the front of, some of the leading magazines, holding them up as one of the darling hedge funds. And Brian Hunter in particular is the star trader on Wall Street. Um, A similar fate for in futures trading occurred at Sumitomo Corporation, which is one of Japan's oldest trading houses. So their star trader Yasuo Hamanaka was head of their copper desk, and at the time one of the most influential figures in the global copper market. at that point. His nickname was, Mr. Copper or sometimes Mr. 5% because at his peak he controlled, roughly 5% of global physical copper supply. Um, so from the mid 1980s up until through 1996, he attempted to corner the copper market. The mechanics were as follows. You build a massive long position in the London Mercantile Exchange, the LME copper futures, while simultaneously acquiring the physical copper. So, right, he's going long in options or the futures market and going long in the physical market. So, it worked, right? Um, because it was basically squeezing short sellers who couldn't borrow against physical copper to short that market. So for a while it worked. Copper prices were artificially elevated. Um, and uh, uh, he ended up hiding losses on the future side by forging documents and conducting unauthorized trades over a 10-year period. So Sumitomo management didn't know what was going on. And it's only when the London Mercantile Exchange and the CFTC, the regulator here in the US for commodity markets, began investigating um, in 95, 96. That's when the scheme began unfolding. So Sumitomo finally caught Hamanaka in June of 1996. They announced a $1.8 billion loss, but later revised that to 2.6 billion. Um, and copper prices dropped something like 25% within days when they unwound all those cornering positions. Hamanaka himself was sentenced to 8 years in prison. So this case prompted significant tightening of London Mercantile Exchange position limits and market abuse rules. This has a similar common thread with Amaranth in that position size that exceeds the market liquidity creates a liquidity trap from which there's no real clean exit. The last case I'm going to leave you with is a more recent one, and this is one of Archegos Capital. Archegos is a family office, or was a family office of Bill Huang. Now, Bill had previously run a hedge fund um, out of Asia called Tiger Asia, a really prominent hedge fund in that arena, and it was shut down for insider trading. So he was barred from managing outside money, which is why Archegos was just a family office running his own money, right? He managed his own $10 billion. Now, his strategy was concentrated in long positions of a handful of large cap stocks, specifically Viacom CBS, Discovery Communications, Tencent Music, and Baidu. And he leveraged these 3 to 8 times through something called total return swaps. And I've talked a bit about these before. Um, Now, here's why this matters. Total return swaps. Basically, what happens is the prime broker, the bank you're working with, buys the actual shares, and then Archegos, in this case, holds only the economic exposure, right? So the shares are actually on the bank's balance sheet, not Archegos's. This has two consequences. First, Archegos can avoid SEC ownership disclosures called 13D or 13G filings. Um, and by, what these filings are required when anyone holding more than 5% of a public company, they have to file these. But of course, the banks are filing these and not Archegos. So with that total return swap, they're economically controlling something like 20% of a company without ever filing anything. Second, and probably more important, the Archegos was working with multiple prime brokers. So Credit Suisse, Nomura, Goldman, Morgan Stanley, UBS, and a few others. But each of them only saw a slice, right, of the exposure. No single bank knew the entire total of exposure at Archegos Capital. So effectively, Huang was simultaneously holding economic positions, something like 25% of Viacom and 35% of Discovery, and had similar concentrated positions in other names. So this leverage was real, right? The exposure was massive, and importantly, it was invisible, right? So in March 22nd of 2021, um, sorry, March 24th, or one of these dates of 2021, Viacom CBS announces a seasoned equity offering, a big one, $3 billion. Dollars. Okay, right? Markets are efficient, so the stock drops, pricing in the new issuance as being dilutive, right? So Archegos gets a bunch of margin calls from multiple prime brokers simultaneously. So over the next couple of days, Huang tells the banks he's working on it and asked him, please don't liquidate me. On the night of Thursday of that week, on March 25th, the prime brokers meet. Goldman and Morgan Stanley realizes that if everyone tried to sell at the same time, the prices would collapse. So they decide to sell first. On Friday morning, March 26th, before markets really open up in volume, Goldman and Morgan Stanley dump roughly $19 billion of Archegos related stocks in different block trades. And they didn't warn Credit Suisse, Nomura, or the others. So by the time that Credit Suisse and Nomura realized what had happened, the stocks had already fallen by 30 to 50%. So they were left holding the bag. Credit Suisse loses something like $5.5 billion. And that is a loss that ultimately contributed to the bank's failure a couple of years later in 2023. You'll notice Credit Suisse no longer exists. It was absorbed by UBS at a song of a price. Nomura lost something close to $3 billion, dollars, and Goldman and Morgan Stanley lost relatively little because, they went first. Archegos itself was wiped out. Huang lost about 20 billion of his own personal net worth in 2 days, and he was later convicted of fraud and sentenced to 18 years in prison. So, what's our lesson here? Um, Lesson is, in a concentrated, opaque, multi-counterparty unwind, the winner is whoever goes first. That's not a stable equilibrium and surely not a good one for asset prices. So, to sum this up, I want to talk about the recurring themes across the 8 cases, talk about the patterns, and give us a forensic comparison. Now, the same handful of failure modes seem to appear in most cases. And what's notable is that fraud is the exception, not necessarily the rule. So there's, three-ish cases here where fraud itself is the notable problem. Um, And in terms of the instruments, what's interesting here is there's nothing really exotic. These are plain vanilla kind of derivative positions, treasury futures, equity index futures, oil futures, natural gas spreads, copper futures, and total return swaps. So none of these are inherently dangerous. They're just simple tools used badly. Now, it appears the root cause in most of these is leverage, some sort of mismatch, like in liquidity, model failure, right? Correlations assumed to be zero go to one, for example, or correlations spreads don't narrow; they can get widened in the meantime, and concentration risk, right? That was the Archegos example. There's also control failures, right? This is probably the most important issue. Every case had identifiable control issues, often at the most basic level, right? Segregation of duties, position limits, exposure aggregation, right? The Archegos case. Um, and so this is sort of the headline lesson here that most derivative disasters are not caused by rogue traders. They're caused by sanction strategies that, the institution understood and approved, and the people who approved them didn't actually understand them, right? It seems to be a recurring theme. So quickly, pattern one in almost every case, leverage was just too much. Orange County, long-term capital management, and Archegos. So it, speeds up the pain, as it were. Pattern number two, models break under stress. Um, because they're calibrated on historical data. We saw this not only in the long-term capital management example, where you wouldn't think that a country would default on its own currency and that the spreads couldn't widen further because they never had. We saw this in the global financial crisis, where we assumed that housing prices never go down, right? And we're not going to have correlated defaults across geographies from that last lecture. So models do break under stress, some modeling failures. Three, controls are boring until they aren't, right? Segregation of duties sounds like an internal audit phrase that you want to ignore, but it's the single most important control in financial services. This is particularly true because all of these are fraud cases, right? So internal controls will find these, root these problems out. So in terms of our risk management imperatives, I have some I have a taxonomy, if you will, of derivative disasters. So this is something you should recognize from each of these specific cases. Excessive leverage, right? This is, think LTCM and Archegos. Model failure, again, LTCM in Orange County, right? Because he didn't think interest rates would go up. The liquidity illusion, this is Amaranth, Metallgesellschaft, Sumitomo. There's control failures at Barings, SocGen, and Sumitomo, right? That's the fraud stuff. Maturity mismatches, we talked a bit about that, especially for Metallgesellschaft. And then incentive misalignment, which we haven't talked much about at all, which arguably applies to all the cases, right? Every trader was based on short-term profit and loss, while shareholders, taxpayers, counterparties, they bear the tail risk. So the most important takeaway here is when you see one of these, you usually see two or three of them kind of stacked on each other. Because these really, really large losses, the catastrophic ones, are almost never a single case here. Um, so last but not least, I'll leave you with some prescriptive takeaways. First, we should measure, limit, and stress test the risk. Now, value at risk is a measure, VAR is a starting point. We didn't talk much about it here. Most of you will have seen this through some other coursework during the program. But it is a risk-based test that many banks use. And the second thing to take away here is that segregation is important, right? You want to segregate all duties, no exception. You can't have a trader processing their own confirmation. They're going to exploit that access. Last but not least, and this, in my opinion, is the single most important thing, is that senior leadership, senior management needs to understand what they are trading. So this happened in, Orange County. This happened in spades during the global financial crisis. No one could even explain what a mortgage-backed security was, or more importantly, a CDO, right? Or even that, on top of that, the CDS that was written to protect all that. No one understood that. So we'll close this lecture, by emphasizing the fact that nothing here requires a PhD, right? The hard part is having the institutional discipline to apply these rules consistently, especially when the desk is making money, right? You want to know why you're making money, such that when you're not, right, you can uncover the fact. All right, and we'll leave it there. Um, I will obviously have Mohsen be proctoring the exam for you guys on Thursday evening this week. So if you have any questions in the meantime, please do feel free to reach out to me via email. I can hop on and do a Zoom office hour with you guys. Okay, we will see you shortly for the exam.